my opinion, the person in charge or the company in charge is more important actually than the real estate that that the group is investing in.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thanks again for jumping into another episode of the Freedom Point. My name is Jeremy Dyer, your host today. And again, I have just an absolute pleasure to introduce to the show and I say the, Brian Burke. Brian, welcome to the show.
Thanks for having me here, Jeremy. This is a lot of fun.
Yeah, and for those that have listened to these episodes regularly or know me personally, you know that I'm a huge fan of Brian Burke and specifically the book that he wrote, the Hands-Off Investor book. So I'm looking very much forward to, diving into, the book, asking a bunch of questions that he has for us to answer. But for those that aren't familiar with Brian, he is the president and CEO of Praxis Capital, which is a vertically integrated real estate private equity firm, which he founded in 2001. Brian has acquired, get this, over $800 million worth of real estate over a 30-year career, including over 4,000 multifamily units and more than 700 single-family homes. Brian, as I mentioned before, is also the author of the Hands-Off Investor book and is a frequent public speaker at real estate conferences and events nationwide. Brian, what did I leave out there?
That pretty much covers it. Nobody wants to hear about me anyway. They want to hear about what to invest in or not to invest in or how to do it. So no one cares about me.
Well, you've got quite a remarkable journey, So can you share your background and what inspired you to write the Hands-Off Investor book and furthermore, become the founder of Praxis Capital?
Yeah, I started investing in real estate with absolutely nothing. I was 20 years old when I made my first real estate investment. I had no money. I had no knowledge. I didn't know anybody. I had no network, no education in real estate. Decided, I was fully equipped to become a real estate investor, right? So I kind of never stopped. Once I did one, I couldn't. I just couldn't quit. So I've been doing this now for 34 years, and maybe I'll be doing it another 34 if the good Lord's willing. But I started out my career, my working journey, I should say, in the mid 1980s. I got a job in a grocery store, and I was bagging groceries. And one of the people in the grocery store, one of the checkers in the grocery store, was middle-aged and had invested in a fourplex when she was young, and the fourplex increased in value tremendously. And I always kind of admired and respected that somebody that worked in a grocery store could own investment real estate, and I really thought that was kind of cool and inspiring at the same time. And then meanwhile, I started my investment journey in real estate and was growing it over the years. And then number of years passed by. I was long gone from the grocery store, but still maintained contact with this person who actually became one of my first investors, really early on in one of my deals. But then a number of years went by, and she decided it was time to sell the fourplex and become more passive. So she put the thing up for sale, got an offer, went into escrow. She decided to do a 1031 exchange and invest the proceeds of that fourplex sale into a syndicated real estate offering. This one in particular was structured as a tenants in common deal. They called them TICs. It was a way that you could structure a passive offering to accept 1031 investment funds, which is a tax-deferred exchange. So she did that. But basically, her entire life savings, her entire retirement was in the equity in these buildings. And she made this investment, and fast forward a couple of years, she came to find out that the sponsor of that investment was a convicted felon who had priors for wire fraud, amongst other things, and stole all the money out of the accounts and lost it all. The real estate that they invested in went into foreclosure. It was 100% wipeout for the investors. The sponsor ended up in prison, and my friend ended up broke. She lost her entire life savings, and as now a veteran of this industry, and people have been telling me, asking me, when are you going to write a book, for like 20 years, and I'm like, I haven't been doing this long enough. Give me a break. But now, as a veteran of this industry, I felt that it was my responsibility to try to educate investors in passive real estate offerings how to properly invest and how to hedge against some of these risks, so that the same thing doesn't happen to you that happened to my friend. And if I could maybe save one person from the same mistake, every minute of writing that book would have been well spent.
Yeah, no, that's a great point. And I'm going to get into the credibility of the sponsor in just a little bit here. But for my listening audience, and in Brian's own words, how would you define what a real estate syndication is?
Real estate syndication is any time any group of people pool money together to invest in anything that is under the control of someone else. Any of that would be considered to be a syndication. Now, it could be you invest in a startup company that's going to develop the next, iPhone app. I mean, it doesn't have to be real estate. Anytime a group of people get together and make an investment and someone else is in charge, it's essentially a syndication. It's common in real estate where a real estate operator will go and find a property to buy and will collect investments from a variety of passive investors to get the capital to make that real estate acquisition. And that's your garden variety typical real estate syndication. But it could look like a lot of different forms. But anytime a group of people get together and it's controlled by someone else, that's a syndication.
Sure. So for somebody that's looking to become a passive investor in a real estate syndication, what are the key factors that they should take into consideration when evaluating or considering such an opportunity?
Well, there's this age-old debate of, horse versus jockey. And some people will say, oh, it doesn't matter who's in charge as long as the deal's good, or it's a solid piece of real estate, or it's at the corner of Main and Main, or it's Class A, or it's this or it's that, tier one market, blah, blah, blah. But really, it really comes down to the sponsor that you're investing with. In my opinion, the person in charge or the company in charge is more important actually than the real estate that that the group is investing in. Case in point, my friend who lost her entire life savings, that was in a Class A property in a good area, but it happened to have a terrible sponsor, and that's how she resulted in 100% loss. You're seeing a lot of situations happening out there right now where there are groups that have bought a lot of real estate in recent years, didn't finance it right. So basically they were set up for failure from day one, and they're running into challenges. So with the economy presenting an adverse market cycle, and they don't have experience and track record to understand how to navigate these adverse markets, and they found themselves in trouble, and their investors are in trouble as well and getting capital calls and so on. So, the most important thing you can look for is the track record of the sponsor. In my opinion, you want to see somebody that's been through market cycles and knows how to not only handle them, but survive them. You want to see somebody that's had full cycle experience, meaning they've actually bought and sold a lot of properties. You'll run into a lot of people out there that say, I've bought, 5,000 units, but have never sold a single one. So they've proven they can take off, but no one's proven they can land. So there's a lot of different things you want to look for, but most of it comes down to experience and the sponsor's integrity.
Yeah, no, I know some of the challenges that sponsors are having in the space today are centered around the debt challenge, right? So can you talk a little bit more about the genesis behind why sponsors are having challenges with debt, and really what decisions they're being forced to make as it relates to providing additional liquidity into those deals to keep them, viable?
Yeah, and it starts before any of that even comes about. When you're acquiring property, you have to make decisions on structure, right? The capital structure of that deal is a decision that's made at the time of the acquisition. And that means how much equity are you going to raise, i.e., capital from your investors? How much debt are you going to get from a lender? And what form is that debt going to take? Is it going to be fixed rate, floating rate, long term, short term? High leverage, low leverage. These are all decisions that sponsors have to make. And over the last few years, we've had this rising tide lifts all boats kind of a market where you could, take a lot of risks and you could make a lot of mistakes and the market would cover your tracks. And that's just no longer here. So, but that market promotes some risky borrowing, and risky borrowing can take the form of high leverage and short maturities. And the reason people did that is debt, especially higher leverage debt, amplifies your results, right? So in a really good market, a lot of debt can make the investor level returns extraordinary. And that had been the case. And people were attracting capital by these extraordinary returns, 20, 30% IRRs and so on. But in a adverse market, that debt can also completely wipe you out. But people weren't thinking that far ahead. It's like, hey, things have been going great. We're going to take on a little more debt than maybe we were even comfortable with. It's going to have 3 to 5 year maturity because that's the maturity horizon you get on some of the higher leverage bridge loan products. And that was really prevalent in the marketplace over the last few years. And now that's causing challenges for those sponsors because 3 years may have seemed like an eternity when you bought the property, but it gets here really quick. So now these loans are coming due and they have to do something, right? They've got to refi, they've got to sell. Well, they can't sell because the market's in the toilet and property values have declined. They can't refi because property values have declined and they don't have the equity in the property to provide a cushion for the next lender. Interest rates are higher, so the properties don't cash flow at prevailing rates at a leverage point that would pay off their existing debt. So that's forcing some sponsors into this uncomfortable position of having to ask investors for more money or debate whether to hand keys back to the bank. It's an ugly scenario, and we've only seen the tip of the iceberg, in my opinion.
Yeah, fortunately, I personally haven't been involved in a lot of investment opportunities that have capital calls, but there are some where the distributions have been suspended for the time being. Why might suspended distributions not be the worst case scenario for a limited partner investor?
I think most people that are in, at least more than a couple syndications are going to find that some, if not all of their sponsors are freezing distributions. I think the only deals out there that could still be distributing are ones that had fixed rate debt, where they were locked in at really low rates. I could see distributions still flowing from those kinds of deals. I could see distributions flowing from Ponzi schemes or deals where sponsors are distributing capital reserves or investors invested capital back to them in the form of a distribution to try to obscure the fact that there isn't actually distributable cash flow being generated by the asset itself. Basically, they're trying to hide the problem or kick the can down the road. I could see distributions coming from that. But any deal that's had floating rate financing or short-term bridge is likely not distributing right now. I mean, there may be some outside cases where that's still possible, but I think in most cases you're going to see frozen distribution. Now, does frozen distributions mean, oh, we're going to lose all our money or the investment has gone down the tubes? The answer to that is maybe. And that again comes back down to the structure of the financing, right? If you've got long-term financing, and there is floating rate long-term financing that does exist. Some sponsors use it. We do. If you've got a long-term horizon for your debt, you can survive through to the next market cycle peak if you've got enough cash reserves to do so. Now, what you don't want to do is be distributing those cash reserves to the investors because they're there for a reason, and that's to weather storms such as this. So, just a frozen distribution in and of itself doesn't mean everything's hit the fan. Now it could mean that, but it doesn't always mean that.
Brian, diversification is a crucial aspect to investing. So, what approach does Praxis Capital use to help investors diversify in their real estate investment holdings?
We a couple of things. One is we invest in different markets across the country. So, we're not just hyper local where we're focused on one geographic market. We've got holdings in several different states, and we've got operational history in about half the country. So, we've got a lot of experience in being in different places, and we spread our portfolio around so that if some like an earthquake wipes out half of California, it's not like, well, the whole portfolio is gone, let's start over. I don't invest in California anyway, but given it, let's say that we did. The other thing that we do is more lately, I'd say within the last 5 or 6 years, most of the acquisitions that we did were done through a real estate fund rather than single asset syndication. And that provides the investor some diversification just by being in a fund. There, you make one investment and you own a piece of multiple properties that might be in multiple areas, which gives you some diversification, as opposed to just buying into a single asset syndication where, if that fails, that's the only thing in there.
Brian, you in your book, you talk a lot about and you emphasize the importance of building a relationship with sponsors. Could you provide advice as to how exactly a passive investor can form a successful relationship with a sponsor?
Yeah, it's kind of like a dating relationship where you start kind of slow and go on a couple dates, and then maybe things get more serious, and then you move in, and it's like you don't just oh hi, nice to meet you, let's get married. Well, it's the same kind of thing in working with a sponsor. You want to get to know who they are. You want to watch what they do. You want to really investigate their track record and all that kind of stuff. But usually it all starts with a phone call. And I'll give you kind of like the flow chart of what it looks like for a new investor that comes to Praxis. Is they might send an email or a contact through the website, for example, and say, hey, I'm interested in what you guys are doing. Our investor relations folks will set up a phone call with them. They'll spend one-on-one time with them in a phone call to explain, this is who we are, this is what we do. And, I think people have heard a lot of us on podcasts and seen me at conferences and other stuff. And so, one of the questions that our IR people will always ask is, what can I tell you about Praxis that you don't already know? Right.
Right.
And so this is kind of a get to know you where we can explain all of that stuff. But even more importantly is it gives our investor relations team the opportunity to ask the investor things about them. Are you looking for cash flow? Are you looking for appreciation? What's your risk tolerance look like? What kind of an investing experience do you have? What are your goals and objectives, all that sort of stuff, so that, we know if we explain an investment opportunity to them that we're sharing something with them that would fit their goals. And it's just a good kind of way to get to know you. After that, it's just, usually it's pretty slow going after that. Maybe you exchange some emails, or, you meet at a conference, or, any number of different things could happen. But most of our investors will watch what we're doing for a while and, from a distance, and wait to see how things work out. And then at some point they get comfortable and we send out a notice of an offering, and they make that investment.
Yeah, absolutely. One question that I have for you, Brian, is market cycles can have an impact on real estate, and market cycles can be global. They can be, local. They can literally drill down to the city, county that the particular property is located in. So my question is what strategies does Praxis Capital use to navigate through different market cycles successfully?
Yeah, we're recording this in November of 2023, and we're seeing an adverse market cycle unfolding before our very eyes, right? One of the things that we employ to hedge against market cycles is an attempt, which we've been pretty good, an attempt to foresee them and make adjustments ahead of time. So, for example, before this market cycle started to go against us, we saw it coming. In 2021, we got the sense that the market was starting to peak out and that it was time to sell. And we had about 4,000 units in our portfolio. We started aggressively selling in 2021. And by June of 2022, we'd sold 75% of our portfolio, leaving behind only Class A properties with 9 years left on their mortgage loan, because we knew we would have to wait until the next market cycle peak before we'd want to sell. So the first is to use timing to your advantage. Get in at the bottom, and in the middle, but get out at the top. And that's easier said than done, but we did it in the last cycle in 07 through 09, and we did it again in this cycle in 21 to 20, who knows what. so I think that's one. The other one is, if you're not comfortable predicting where markets are going to go, or you acknowledge that maybe that's impossible, which perhaps it is, and we got lucky. The other thing you can do is you can structure your financing to prepare for these kinds of things. And this is probably most people's best defense, is don't over leverage. In other words, don't go out and take on too much debt. Keep a reasonable loan to value ratio, raise more equity. I mean, let's face it, we've never been the IRR leader where we're the one out there going like, we're going to get you the highest return. We usually take the opposite approach. If you are chasing the highest return, go invest with someone else, because we're not going to do that. We're going to use conservative leverage. We're not going to beat everybody else on IRR. But if the market turns against us, we're going to survive. And, I can't say what the other investments are going to do one way or the other. The other thing is have a lot of cash reserves. And I learned this lesson in the 09 recession, when, 08, 09, watching most of the foreclosed real estate that we were buying was being lost by people that had one of two ills. Either they had too much debt or they ran out of cash. And if you can position yourself so that you don't run out of cash and you don't have too much debt, you can survive an adverse market cycle and just sell at the next market cycle peak. Then you don't have to worry about trying to predict them.
Where do you think, and I know you don't have a crystal ball, and to me, it sounds a lot like the most current headwinds in real estate are really tied directly to the interest rate challenges, right? So is it fair to say that in order to get out of this current economic slump or cycle that we're in real estate, it's going to be directly correlated to where interest rates are headed in the future?
Well, I think that's part of it, but there's more nuances to it than just that. I mean, if it were that simple, I would feel a lot more comfortable, but it's not quite. There's a couple of different. There's probably, I think, 3 different ills in the market right now. One is obvious. That's interest rate. Borrowing costs have gone up dramatically, and that's made it a lot more difficult to get deals to pencil. It's made it more difficult for existing deals to cash flow if they have exposure to interest rate movements. So certainly that is true. But also other things are happening. Right now, you're seeing year over year rent declines in some markets. And, especially Sunbelt markets that used to be kind of the belle of the ball. Everybody wanted to buy in, Arizona, Texas, Georgia, Florida, kind of those southern states. Certainly that's where we've been buying. And those markets have experienced, 20, 30, even 40% annualized rent growth for short bursts of time. And, they're right now are probably the ones getting hit the hardest with rent declines nationwide. And to some could argue, well, that's just kind of a correction, and they're a little bit lower, but they're still higher than they were 2 years ago. It's like, well, that's great if you owned it 2 years ago, but if you bought it a year ago, that doesn't make you feel any better. So that's an issue. And then the third issue is, well, and that's also kind of layered in with construction. There's a record deliveries, especially in the southern half of the U.S. right now on new construction, which is also providing a headwind to rent growth. And then finally, it's price expectation. And this is really the other one, where you've got a lot of trades that happened over the last, call it 3 or 4 years. And those owners have a really high basis. They don't want to sell at a price that would allow a buyer coming in with today's cost of capital and today's reality of rent growth to actually get the deal to pencil. So they're not selling. So there's less property available to acquire. And even if you would acquire it, you can't get it to work. So pricing expectations need to reset. That will happen when some of those owners are backed into a corner. I think that's part of it. These construction needs to slow down some, which will probably happen because construction loans are difficult to get. So we'll probably see that. And interest rates need to decline. And or they don't. I mean, interest rates don't really need to decline. They're fine where they are, but you'd have to buy real estate at a much lower price than people are used to in order for those properties to perform with today's borrowing costs.
Brian, I'd like to talk about the pitch deck or the deal deck. So, what would you say to that passive investor that has the temptation of chasing after a higher IRR or a higher equity multiple? And maybe I'll take a step further and say, what are some ways that passive investor can challenge some of the investment sponsors' assumptions that they've made?
Well, in order to challenge the assumptions, you first have to educate yourself on what assumptions are reasonable. And, if you're an experienced active real estate operator and you've done this yourself, you probably have a really good sense of what operating costs should be. You might know what insurance rates are. You might know, what various things cost. And that's a real leg up. If you don't, it's helpful to get educated in that. And there's data that's out there that you can get that gives average costs and stuff like that. And some of it's accurate, some of it's not. I could point people to the Hands-Off Investor. The book I wrote has an entire chapter dedicated to this very topic of sponsor assumptions, and I give some guidance on what might be reasonable and what might not be reasonable. Now, I would caution that over time, all of those numbers evolve as inflation sets in and makes payroll costs go higher and those sorts of things. But I think if you look at multiple offerings from multiple sponsors, you start to get a better sense of what costs really are when, everybody's saying that payroll is going to be $1,500 a unit per year. And then you get a sponsor that's showing you a 30% IRR and their payroll's $800 a unit a year. That might be a clue that those two things are related, that they're undershooting the expenses is overshooting their IRR. I would just keep your eyes open and look at a lot of different data points and make comparisons. Don't chase that IRR. You're looking for a fair risk-adjusted return. And I'll give you the secret right now. If you want to make a passive investment in real estate, expect to get somewhere between 11% and 15% IRR. If the sponsor is projecting anything higher than that, be leery of whether or not there's risk involved in getting there. And that could be in the form of higher debt leverage. It could be in the form of just mistakes in the underwriting or undershooting the expenses or lofty expectations about how they can compress expenses, or it might have rent growth that's above market or impossible to achieve in today's marketplace. So there's a lot of different reasons why that higher IRR, that higher promised IRR might be in their pitch deck. Your job as a passive investor is to kind of separate the wheat from the chaff and figure out, which ones of these offerings are using good inputs to get a good output and which ones is garbage in, garbage out.
One question that I get a lot from potential investors is this concept of investing with sponsors that are vertically integrated on the property management and the building construction side versus those sponsors that use third parties. What's your thoughts on that topic?
Well, there's really nothing wrong with either approach. I think just in general, sponsors that use third-party management tend to be newer, smaller, or less experienced sponsors because they're trying to build their infrastructure and maybe they haven't grown large enough to support their own vertical integration. We vertically integrated about, 8 years ago or so. And I made the decision based on a couple of factors. One is if we were going to look for institutional capital, in other words, groups that could write a $10 million check, for example, those investors are expecting that their sponsors are vertically integrated because they've learned over time that their vertically integrated sponsors tend to outperform they're non-vertically integrated sponsors. So there must be something to it because they write big checks, and if they say it's so, then it must be so. The other reason that we did it is just to have more control over our own assets and our own data. When you're getting property management statements from 5 different property managers, it all comes in different formats, and it's just difficult to really get portfolio level KPIs and that sort of stuff. So just having full control was another good reason to vertically integrate. And finally, and probably the most important reason I vertically integrated is because I was able to add somebody to my team who had been doing it for 40 years, managing, in charge of management companies for 40 years, and probably 50,000 or 60,000 units of multifamily management experience. And when you have an opportunity to put someone on your team with that kind of experience, you don't pass that opportunity by. And a group that is or a third party managing probably doesn't have someone with that kind of skill set on their bench. And I think that's important to have.
Sure. What's up next for Brian Burke and Praxis Capital?
Who knows? That's a good question. I've been spending a lot of time working on my golf game and, spending time on the beach. This has been not really the best market to be investing or buying, but that's going to change. So I think what's next for me is at some point, the market is going to present opportunities. And, I want to be there to sweep the glass up out of the street after the collision's been cleared.
How's your golf game going?
Not so good. Yeah, I'm much better at real estate.
Yeah, well, keep up at it, okay? Practice.
I'll try.
Sounds good.
That's right.
So outside of the Hands-Off Investor book, which is one of my by far favorites, what might be one or two other book or podcast recommendations that you'd encourage listeners to check out?
There's a book written by Gene Trowbridge called It's a Whole New Business. And it's a book, it's really a book written for syndicators, how to syndicate, right? What running a syndication is all about. But it's actually, I think passive investors could pick something up out of that too, because the more you know about what's going on behind the scenes, the more educated you are as an investor. So I don't know, maybe check that one out. Podcast wise, I think anything that's dealing with making passive investments is a good one. I've been on the Left Field Investors podcast a couple times. Those guys do a really good job, I think, of talking about what's going on in the market and talking about real estate sponsors, that sort of stuff. So maybe I'd suggest that one.
Yeah, great. We'll put those in the show notes. And those that are listening to this episode, the one that was produced directly before this one will air was with Jim Pfeiffer from Left Field Investors. So you guys went back to back. He told me that you'd be a better guest than he was.
Oh, no, he's totally blowing smoke. That's not true. And now that I know that he was on, I'm going to have to take a listen to that one.
Yeah, absolutely. I really appreciate you being on the show. What would be maybe one or two different ways that our listening audience can either connect with you or connect with somebody, on the Praxis Capital team?
Yeah, for sure. Well, if anybody's interested in knowing everything I know, it's contained within 350 pages. You can go to biggerpockets.com/syndication book and you'll know everything I know. So maybe check that out. You can also reach out to me on through our company website for Praxis Capital. That website is praxcap.com. It's praxcap.com. You could follow me on Instagram at Investor Brian Burke, or maybe you'll catch me on the forums answering questions on biggerpockets.com. You never know.
That's great. You haven't set up your TikTok account yet, huh?
I don't even know what that is.
All right, good. Probably a good idea to stay off that platform. But Brian, I've really appreciated this. This has been just an awesome time to get to know you really for the first time. As I've said before on my podcast episodes, this is somewhat of a bit of a crush, for me to be able to have you, join me on my podcast. So again, I really appreciate your time.
Oh, it was my pleasure to be here and happy to come back anytime you'll have me.
Sounds good. And listening audience, thank you again for joining us for another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.